Hey, it's Tim. It's about 8:30. Emerging markets are following the January effect into full swing. Asian equities extended the rally further off of the U.S. markets yesterday. London back in gear. GDRs trading for a lot of the big EMs again in London, especially Russia up 3%. So, you've got a real strong backdrop. Ultimately, Mr. Market is a cruel man, and this just may be some bait, as a lot of technical signals are at least keeping people a bit cautious. But the China story is important. The local press reporting that there's going to be a delay in the implementation of the property tax. That's ultimately at least giving a feel for a soft landing and a stronger drive for a lot of the resource-related names. Coal also getting the boost from the Australian flooding. So rare earth, aluminum, iron ore, these are all places that are reasonably strong. And I think if you add that into the global markets data that's coming through, we had big numbers yesterday on PMIs and just about everywhere today. UK joining into the party, their PMI at a 16-year high. So I think adding that to the U.S. is 17th straight month of manufacturing expansion. It makes Friday's non-farm payroll loom very large. Maybe that's the trigger point down. In other words, if markets can't rally on a decent number, or if it is a true disappointment. Hard to see that with some of the jobless claims numbers we've had, and I don't mean the one from last week, but I mean the trend leading into this number. So I think last week's payroll number, jobless claims number, is something that should start to set the stage for the recovery that most people are expecting we're going to see in January's number. But keep an eye on that. The auto sales numbers that are out in the U.S. today, I think, will highlight the resurgence in global autos. If the U.S. is stronger, you can bet that they're stronger in a lot of other places. So keep an eye on that. We're going to talk about the Aussie flood and the impact on all of the coal names and a lot of the resource plays related to that on Trading the Globe. So keep an eye on that this morning. And I highlight the fact that in 3 or 4 of the main broker reads I've had this morning, and you've got Russia as an overweight in just about everybody's book. Keep an eye on that only because it actually has me a bit concerned that sentiment has changed so dramatically after Russia was really left for dead in the early part of the rally last year. But the oil names at $100 oil, which is now seemingly consensus, and hedge fund positioning in oil trade right now is at a 4-year high. Again, is that a concern? All of these things are just, I think, important reminders that sentiment can't be so runaway bullish in a world where we have the same problems we had last year, just a month ago, where people were very concerned on China. They were very concerned on European sovereign issues. And the sustainability of the U.S. labor market is very much in question. The U.S. housing market and house prices, some would say, are heading into double dip camp. So keep all that in mind. It's January. Allocations are strong. Last year, you were lifted up only to be dropped down by the middle of the month. So stay cautious.